All right, let's jump right in. If you've ever dipped your toes into investing, you've definitely come across ETFs. But wow, trying to pick the right one, it can feel like you're staring at a wall of options, totally lost.
I mean, with literally thousands of them out there, it's so easy to feel completely swamped. Do you just, I don't know, pick the one with the coolest ticker symbol? Or the one with the lowest fee? A lot of the time it feels like you're just guessing, and that can leave you totally frozen, not knowing what to do.
But here's the good news. It really doesn't have to be like that. Today, we're going to break down a super simple 5-point framework that just cuts through all that noise. Think of this as your personal guide to picking the right ETF for the right reasons every single time. It's about investing with confidence.
Okay, let's get into it. First things first, and I can't stress this enough, this is the foundation for everything else. You've got to define your goal. Seriously, before you even look at a single ETF, you have to know why. Why are you investing in the first place?
And it all boils down to this one single, powerful question. What is this ETF supposed to do for you? Like, what's its job in your portfolio? Are you trying to grow your money like crazy for the next 30 years? Or are you maybe looking for a steady stream of income right now? The answer to that question? Well, that's your North Star.
And you'll find your answer usually falls into one of these buckets right here. These are the most common goals, right? Maybe you're playing the long game. You want growth, so you look at something broad like an S&P 500 fund. Or maybe you need cash flow now, so income from dividends is your focus. Or hey, maybe you're really excited about a specific trend like AI or clean energy. Your goal is what lets you filter out everything else and just focus on what matters to you.
And this quote just hits the nail on the head. This is the biggest trap people fall into. You hear some hype about a hot new AI ETF, you jump in and buy it, and then you try to figure out where it fits. That's completely backward. You have to start with your goal. Always the goal first, not the product.
All right, so once your goal is locked in, it's time to pop the hood and see what's actually going on inside. This brings us to point number 2, check in the ETF's blueprint. You got to know how this thing is actually built.
So, one of the first things you'll see is how the ETF actually tracks its index. On one hand, you've got a physical ETF. This is super straightforward. It actually goes out and buys the stocks or bonds it's supposed to own. Very transparent. On the other hand, there's a synthetic ETF. This one's a bit different. It uses financial contracts, like swaps, to mirror the index's return. It can be more efficient, but it does come with something called counterparty risk. All that means is there's a small risk that the other side of that contract, the bank or institution promising the return, might not be able to pay up.
Next up in the blueprint, what happens with dividends? An accumulating ETF is kind of like setting your growth on autopilot. It takes any dividends paid out by the companies and automatically reinvests them for you. This is amazing for compounding your wealth over the long term. Then you have a distributing ETF, which pays those dividends out to you as cold, hard cash. Perfect if your goal is generating income. See how it all links back to your goal? And your tax situation, of course.
Okay, and this next one. This is a biggie that a lot of people just gloss over. You can't forget about the index methodology. An ETF is really just a wrapper for an index, right? So you have to understand the rules that index plays by.
What do I mean by rules? Well, how does a company even get into the index? What are the criteria? And once they're in, how are they weighted? Is it based on size, so Apple gets a huge slice? Or is every company an equal slice of the pie? And how often do they rebalance things? You could have 2 ETFs, both called a China ETF, but because their indexes have different rules, they could hold totally different companies. That's why the blueprint is so important.
So, we've got our goal, we understand how the ETF is built, now it's time for a little health check. Let's talk about efficiency and the costs, both the obvious ones and the sneaky hidden ones that can really eat away at your returns over time.
First up, you'll see a metric called AUM, which just stands for Assets Under Management. It's basically the total amount of money inside the fund. Now, it's not a perfect science, but a good rule of thumb is to look for funds with over, say, $100 million. It's generally a sign of stability, it shows other investors have confidence, and it means the fund is much less likely to suddenly close down.
Next, you've got the bid-ask spread. The easiest way to think about this is like the fee you pay when you exchange currency at the airport. It's a tiny hidden cost for the convenience of buying or selling right now. You want this spread to be as tight, as small as possible. A wide spread is just you paying more than you have to.
And then there's something called tracking error. This one's really simple. It just measures how well the ETF is doing its one job, following its index.
If the tracking error is high, it means the ETF's performance is all over the place, compared to what it's supposed to be doing. You want this number to be as close to zero as you can get.
Now let's talk about the most famous cost of all, the expense ratio. And this chart, this really tells the story. You look at the difference between 0.07% and 0.30%, and it seems like nothing, right? It's pocket change. But just look at what happens over 20 years to a $10,000 investment. That tiny, tiny difference in fees can literally cost you thousands of dollars. It's a silent killer of returns.
So here's the absolute key takeaway on costs. Don't, and I mean don't, just look at the expense ratio. The real cost, the total cost of ownership, is a combination of everything. It's that expense ratio, plus the cost from the bid-ask spread, plus something called tracking drag, which is just the slow bleed from fees and other little inefficiencies. You have to look at the whole picture to find the most efficient fund.
All right, we've covered a lot. We defined our goal, we checked the blueprint, we measured all the costs. Now, let's put it all together into one simple, powerful tool, your final checklist to make this whole process repeatable and stress-free. And here it is. This is it, your 5-point checklist. Before you ever click that buy button, just quickly run through these 5 questions. Number 1, objective. Does this thing actually match the goal you set way back at the beginning? 2, structure. Is it physical or synthetic, accumulating or distributing? Does it fit your plan? 3, liquidity. Is it easy and cheap to trade? Check that AUM and the bid-ask spread. 4, efficiency. Are the fees and the tracking error nice and low? And finally, number 5, index. Do you actually understand the rules of the road for the index it's tracking? If you can give a confident yes to all 5 of these, you're no longer guessing. You're making a smart, informed decision. So, there you have it. A clear, straightforward framework to cut through the confusion and navigate the world of ETFs. And remember, the point isn't to find the best ETF on the planet. It's about finding the absolute best ETF for you, for your goals. So now that you have the tools, what are you going to build with them?